In this presentation, we'll take a look at rental property as it relates to taxation, giving an overview of rent. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Rental property. Rental property will generally be recorded on a Schedule E, which will then be carried over to the Form 1040 for individual tax preparers. Income expenses from rental property are generally reported on the Schedule E. We can think of the Schedule E as similar to the Schedule C, but for rental property. So we're going to have a similar type of setup in that we'll have an income statement type of setup. The income statement, however, being a little bit more specific to typical type of rental property. Within that income statement on the Schedule E, we're going to have the ordinary and necessary expenses, which are deductible. So we have that same kind of requirement that we have ordinary and necessary expenses for the running of the rental property as things that can be deducted on the Schedule E in a similar way as they would on a Schedule C. In an income statement type format, we would have the income, the rental income, minus the ordinary and necessary expenses. Common rental expenses that would be reported on the Schedule E include things like advertising, repairs and maintenance, management fees, and depreciation. These are things that we would expect to see as typical types of ordinary and necessary expenses on a Schedule E on an income statement related to the rental property. Rental property depreciation. If we have the rental property, of course, we own the rental property, then we have to think about depreciation. Note that if we're talking about individuals, we might have the home, which we do not really record on the tax return unless there's something going on with it, like a business in it or something like that. The home is personal. If we have the home and then we have now rental property that we rent out, then that rental property is something that we're using for business, and therefore we need to record the depreciation related to it. Rental property is going to be large, of course, compared to other types of things that we depreciate. So it might have methods of depreciation. The life of depreciation will differ than the life of, say, our car or something like that. So the rental property depreciation is typically going to be using a straight line method. Residential property has a 27.5 life, non-residential 39. So note, those are significant periods of time that we have to depreciate the building over. In other words, if we buy the building just for the rental of it, then we have to take the cost of that building, in essence, and allocate it over 27.5 to 39 years, long time. And we have to do that with a straight line method rather than having some kind of accelerated method. Just be aware that because of that, then, there is an incentive with rental property to try to break out the components that are land versus building versus other types of things that might have shorter lives. If there are things within the rental building, in other words, that we could say that are actually purchases of equipment, so then we might be able to depreciate it off to 5 to 7 years, those components, and be able to front load or depreciate more in the beginning years some items. So that's just one thing to just keep in mind when you're thinking about the rental property. Just note that rental property in general, 27.5, 39-year depreciation. It may be appropriate to record the rental property on Schedule C rather than the Schedule E if the rental property is a trade or business. If a taxpayer materially participates in the rental activity and is a real estate professional, the activity may be considered a trade or business. If that is indeed the case, then we'll use the Schedule C rather than the Schedule E. Rental property income. So if we think about the typical Schedule E, what's going to be the income line? What's going to be the line for income? It's going to be the rental income, and it's going to be including what the tenant paid, as well as tenant paid expenses or services provided instead of paying rent. So in other words, obviously the cash payments we get from the tenant will be included in the rental income, but if we get other types of payments, such as the tenant doing some kind of maintenance or work in lieu of or for the decline of, we take away the rent and they do maintenance for it, then of course the cost of that maintenance, the fair market value or the cost of the rental, is still something that should be included in as rental. And of course, if we receive any payment other than cash, so if we get some type of payment that is non-cash, some kind of barter type of payment, then that payment would still need to be something that should be included at the fair market value or the cost of the rental as income. For more accounting information and accounting courses, visit our website at accountinginstruction.info.